This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL Coveel. Not filtered, raw, honest. That's my passion. If you like this podcast, if you want me to continue, well, I'm not going to exactly stop whether you want me to do anything or not. And I'm talking about you, the audience, whoever's listening. I just enjoy doing this. It's fun. It's like learning nonstop from some of the brightest people on the planet and a wide variety of subjects. I really don't apologize for that. In my mind, all of the guests that I have on this podcast are connected. There's some through line that I see in my mind. Now, I've not written down that through line, so I can't tell you exactly what it is, but it's there. I swear it's there. If you like this podcast, go to www.covel.com/iTunes, covel.com/iTunes. Drives you right into my iTunes page on Apple. Write a review. Say something. Hopefully good. I mean, if you want to say something bad, that's fine too. Say something good for your time and toil. I will send you a free DVD of Trend Following extras. All you have to do is write a review, send me an email, drop me an email and say, Mike, send me a DVD. My email is real simple. It's my first name at mylastname.com, michael@covel.com. So please, add to the gusto. Help the cause. Push the podcast forward even more. It allows me even more leverage to get great guests. It's all part of the 2015 circa system of how it all works, digital bits and bytes. My guest today is Tim Price. This is his second appearance on my show. Tim is a partner and director of investment at PFP Wealth Management in the UK. Tim brings that very down-to-earth perspective. What is going on fundamentally? What can we see in the central banks? What actions have taken place in the last bunch of years? What are we to make of all this? Now, before you think that Tim and I are going to sit around and make predictions about what's going to happen, no, we're not. But we are pretty good observers. Tim is probably a better observer of these types of events and the current macro situation than I am. Most assuredly, he's on top of it way more than I am. But I just enjoy these types of conversations. What is going on in the economy? The geopolitical situation? Where's it all headed? And even if we were to think about where it's all headed, Tim will say this, I will say this, that doesn't mean a hill of beans difference when it comes to making a market bet. Because the way the fundamentals might unfold or not unfold, not necessarily tied to whether you make money or not make money. Yeah, it's tricky. Not as easy as they tell us in college. Not as easy as they tell us on CNBC. It's a little bit different. I hope you enjoyed this conversation with Tim Price. And I caught the one quote that I liked in part of your writing, and it was, quote, "The fundamentals are utterly shocking," end quote. Now, they've been utterly shocking for a long time, and I give you props because there's a lot of guys that look at the fundamentals that don't necessarily look at the strategy, and I've seen you promote other types of strategies like managed futures, and I've seen you talk about the uncertainty and like, look, even though the fundamentals might be utterly shocking, they could be utterly shocking for the next 10 years for all we know.
Well, I mean, Japan's certainly shown that fundamentals can remain lousy and stay lousy for a generation.
Yeah, and I think it's tough to be somebody that wants to bring the truth. And I'm just curious to how you feel, because here for several years now, you're kind of trying to bring the truth. But it's got to be a little bit daunting when you're going up against governments and central banks that will do anything and everything to make things look pretty.
It is a bit lonely. I mean, it's a bit like a tale of two markets in a way. The thing that I used to be defensive about not having a sort of background in economics, and now I couldn't be more, if you like, enthusiastic about not having brought sort of mainstream economics as part of the baggage into the way I look at the investment market. So 2007, 2008 forced me at least to sort of, to make up for lost time and get some kind of grounding and trying to understand what the hell was going on. And the only thing that made sense to me at the time was basically the Austrian perspective, the Austrian school perspective on, business cycle theory and money production, that kind of stuff. And if anybody, I mean, I'm certainly no expert on the topic, but I just got a sort of rudimentary, as much by sort of moving in the sort of the right kind of circles, or what I felt were the right kind of circles. I started mixing with a lot of, let's call them sort of Austrian school thinkers. And the way I would summarize it, I think this is specifically Ludwig von Mises. The way I would summarize that approach is it's really beyond, apart from anything else, it's a fundamental belief in the primacy of sound money, small government, and sort of broadly libertarian policies. And I think the tragedy of our time is that we no longer have any of those things. And there's one specific recommendation. It would be Murray Rothbard's book, America's Great Depression. And I say this in the light of, I spent with my fiancée much of the last weekend. We stumbled on one of the channels we get for free in our TV package in London is PBS. And there's a Ken Burns documentary about the history of the Roosevelts. I don't know if you've seen it. So you had Teddy Roosevelt, and then more latterly you had FDR, Franklin Delano Roosevelt, the sort of the Great Depression president. Now, when I sort of rather cursorily studied the Depression at school, I mean, we had a full, 40-minute lesson devoted to the 1930s. And the way it was conveyed was basically you had the Great Crash in 1929, and then that for some reason mysteriously triggered a sort of an epic economic depression. Everything was appalling. And then you had this guy, Roosevelt, basically parachuted in. He set up a bunch of alphabet agencies, huge stimulus, and then somewhat weirdly, the depression ended. And that was basically it. So Roosevelt was given a lot of credit for sort of, for stimulus. When you read Murray Rothbard's America's Great Depression, you get a completely 180 degrees different take on things. And effectively, to sum that up, and it's a very readable book for anyone that hasn't read it. It's very, very readable, very engaging. Basically says, if you want to try and clear up a depression, just let the government do nothing. Almost force the government to do nothing. And by allowing the free market to work its magic, and its magic is kind of nature red in tooth and claw. So I'm not suggesting for a moment it's easy, but if you let that happen, the recession or depression will blow itself out. And I'm pretty sure that I haven't read it yet, but a colleague of mine's in the process of reading it, but I'm pretty sure that Jim Grant has just written a study of an earlier recession in the early 1920s, and it was the recession that basically cured itself. I think it's like the subtitle, that the more government can do just to step out of the way, in other words, if government could literally just stand by and do nothing, these problems would be resolved a lot quicker. So one of the reasons, arguably, because it was a revelation when I read that book, the Rothbard book a few years ago at the height of the sort of 08 crisis. And if you then view the world through that mindset, and this isn't a political point, it's not a party political point, but it is a sort of anti-big government point, that Rothbard's prescription is basically along the lines of, if you want to perpetuate a depression, you do everything that our governments are doing now. Okay,
Tim, let me play devil's advocate. So in the States, and I can look at the Shanghai Composite as well. So you look at the Shanghai Composite, you look at the S&P, the Dow, they're all at lofty levels. I mean, people are looking at their accounts and they are feeling good. The unemployment rate, I see the headlines from the States, and the unemployment rate in the States has just gone down way, way down the last 4 or 5 years. How do you respond to the people that are looking at the numbers and they're saying, gosh, Tim, you're asking me to worry about something that I don't see. Now, granted, Tim, I no longer get interest income. I don't have that anymore, but my stocks are at all-time highs and the unemployment rates come down.
To benefit from, well, let's see, which constituency has QE and ZERP benefited? It has benefited people with assets. Because QE has basically boosted the prices of pretty much every financial asset. It's boosted the prices of stocks. It's boosted the prices of bonds. It's boosted the prices of real estate. And that's happened pretty much everywhere. So we had this effect in the US. We've had this effect in the UK, which has been no laggard when it comes to money printing. We've had this effect in Japan. We're now having it in China. And we've lately started enjoying, quote, enjoying, unquote, the experience in Europe. So everyone's doing it. To benefit from QE, you have to own financial assets. If you do not own financial assets, you've benefited not one iota from this policy. But there's also a distinction between nominal and real, and everyone's looking at nominal returns. So, stock markets are at new nominal highs. Whether they're actually at new real highs is a more open question. They're not new real highs in the UK, for example, because we're just back to where we were 15 years ago. So I will accept that it's clearly, for anyone that's asset rich, this has been a fantastic time. But for anyone that's a saver, this has been an absolute disaster. I mean, the most bizarre experience, apart from the fact that a quarter of the Eurozone sovereign debt market now offering negative yields, which is in itself absurd and crazy and a little bit disturbing. You also have, I think it's Denmark, which is like ground zero for this new monetary experiment in madness. So there's an account of this lady, this Danish entrepreneur who took out a small business loan, and she's being paid to take out the loan. So she's not receiving a lot. It's only a little bit over $1 equivalent per month, but the bank is paying her to borrow money. That's absurd. And at the same time, someone who's a depositor with a Danish bank is having to pay 50 basis points just for the privilege of having the account. So they're being penalized. So yes, it's this stimulus. The stimulatory environment has hugely benefited the asset rich, or for that matter, also the huge debtors. The biggest constituents all being governments themselves. But for anyone that's simply a saver, this has been a disaster.
In the States, I know it's a pretty high number. I want to say it's like 50% of the population basically has no money in the bank. So
they live month to month, paycheck to paycheck.
Are the savers essentially the asset rich to begin with? And here's the question I have, because I think you've talked about savers suffering in silence, but I somewhat think that this has all been kind of an elaborate bribe. And the bribe has been, we scared the pants off you in the fall of 2008. We basically told you the ATMs weren't going to work. Give us carte blanche to do anything we want. Now, here's your present. We're going to make stocks go back up. While we scared the bejesus out of you, we're going to make stocks go back up, but you get no more interest income. Now, be quiet. Is that too far from reality?
I can certainly accept that, that pretty much everybody, for anybody working in the investment markets in any capacity in 2007 and particularly 2008, it was like staring into the abyss. So the Bank of England here, it took them a year to concede that they came within hours of closing down the UK operations of two of our biggest banks, namely Lloyds and RBS. Now, if that had happened, you would have had people going basically to the ATM machine at the end of the week or the end of the month, not only finding that there's no money in their account, finding that there's no money in their bank. Now, that's a recipe for, well, depends how terrified you want to make yourself, but it's a recipe for, at best, it's a recipe for martial law, because you would have social unrest in that kind of an environment. And we came very, very close, but it took the Bank of England a year to acknowledge that fact. So we clearly were up against it. I would argue there's clearly no counterfactual, so we'll never know how any of this stuff could have gone down differently. The way I've described it, there's a fabulous bit in Andrew Ross Sorkin's account of the Lehman failure, too big to fail. And it looks like Sorkin had just amazing sources, because it seems like these guys went semi on the record, so he's got practically verbatim transcripts of conference calls, private conference calls that happened at, say, at JP Morgan. And one of the chapters in that book begins with effectively a transcript of the meeting that Jamie Dimon had with the board of JP Morgan on the Saturday of the weekend that Lehman failed. So that the day before, effectively, they filed for Chapter 11. And he says, and this is to the board of JP Morgan, he says, we should be prepared for, some of the most incredible experiences that has ever happened in American capitalism. We should be prepared for Lehman Brothers filing. We should be prepared for Merrill Lynch filing. We should be prepared for Morgan Stanley filing. Pause. We should be prepared for Goldman Sachs filing. And it says, like, there was a sharp intake of breath on the other end of the line. You're thinking, no shit. That didn't happen. That's not how it happened. So, you could argue that it was the right thing or the wrong thing to let Lehman Brothers fail. But quite clearly, after that decision it was made, or they were forced, the authorities were forced for that to happen, to make that happen, then quite clearly they went into reverse and everybody else got bailed out. So you had shotgun weddings arranged between all the remaining investment banks, and AIG got bailed out, and we know what now happened. But there is a counterfactual. There is a possibility that they could have let the chips fall slightly differently. Here in the UK, for example, because this was happening at around the same time, I accept it would have been utterly beyond the pale to let any high street bank fail, because the system would just have collapsed. But rather than maintain the sort of legal fiction that the likes of Lloyds and RBS were really going concerns, and allow a sort of rump of shareholder participation, I think it's perfectly valid to say, well, they could have just nationalized them. The government could just have taken both of those banks, for example, and clearly by extension you could have done something similar in the States. You could have had nationalization of those entities, and the system would still have persisted, but you wouldn't have had that fiction that that those were going concerns. People would have come to the realization that this is a bad deal, that these businesses are seriously impaired. So that's my sort of my counter proposal. It could have gone down a different way. But as it is, we've had this sort of slow recovery process, and the banks have been bailed out, and the system sort of, people think, well, the system's sort of on the road to recovery. But the great myth here is that there's been deleveraging. And the reality is there was a big study done by, I think it was McKinsey a few months ago. And so we're living with this myth that there's been a deleveraging of the system. The reality is there's even more debt now than there was when Lehman went down. So this, there's a gigantic confidence trick being played here. And I would accept that I probably over-obsess about, let's say, the debt situation, because my background was originally in the bond market. So I was originally a bond salesman. So I trace everything back to the sort of ground zero of the fact there is too much debt in the system, that debt cannot be paid back. And if you accept that the debt can't be paid back, or if you accept that, then there's really only three scenarios that can come to bear. And they're all sort of mutually exclusive. So the first is that you allow sufficient economic growth to service that increasingly rising debt load. That's option number one. And I'd suggested in the Eurozone that is now impossible. And if it's not impossible, it's certainly going to be very, very difficult. Item one for the prosecution would be Greece, which looks like at any moment it is going to leave the Eurozone. But, it's been on the precipice now for years. So the first outcome is enough economic growth to service the debt. And that's clearly been assisted in this sort of, zero interest rate policy and all the rest. The second option is that you default, you repudiate the debt, and since we operate in a debt-based monetary system, that's the equivalent of Armageddon. Option number three is the option that every government throughout history has ultimately always resorted to, which is you inflate the problem away. And that's essentially part, I think, of what QE's been about. It's to try and trigger inflation. It's clearly worked at a level of financial asset prices, but it has yet to work in the sort of the inflation that most people accept as being inflation, which is effectively a second-order price impact in the level of sort of generalized goods and services. So, which do we get? Option one is growth. Option two is default. Option three is inflation. My sense is that and people have been debating this and worrying about this and discussing this for at least 7 years now. It now seems like the jury's come back in. I think the long-term perspective is, as far as I'm concerned, still clearly an inflationary one. That's what all of these governments desperately need, because they cannot survive a deflation. If you've got already more debt than you can possibly really handle, then, a deflation basically is game over. What is incredible to watch as a sort of bystander, if you like, or just a sort of, objective observer, is despite the trillions of dollars, pounds, euros, and yen that have been printed, where's the inflation? So it hasn't been enough. So although you've had huge money creation, huge money printing by the central banks of the developed economies, that has not in itself been enough to compensate for the amount of voluntary paying down of debt that the private sector has been doing, that corporates have been doing, that households have been doing. And it's pretty scary that in a fiat currency world, you can even have deflation, but yet we seem to be having it. If one question has been answered, for me at least, it's what do we get? Well, I think it now seems quite clear. What we get is deflation or the threat of deflation today. And if that threat becomes any more endemic, then it'll be met by even more aggressive reflationary or inflationary monetary policy response. So if you thought that QE iterations 1 through 4 were big, then get a load of what QE5 will look like. And that, I think, is what we're, and the market, that's clearly what the market's now sort of scratching its head about and thinking, well, can the Fed ever really raise rates? And as I've read on several occasions by a variety of people, you cannot taper a Ponzi scheme. You simply can't. So that in a sense, the prospect of rates ever rising seems a bit bizarre. The U.S. economy is now in reasonable health. It's not like it has had emergency interest rates now since 2008. But we're not in an emergency anymore, and yet interest rates are still at rock bottom levels. So explain that.
Well, I was going to say, you say we're not an emergency anymore, then why the necessity to look like we're an emergency, the necessity to act like we're an emergency?
Well, I completely agree. I mean, one thing that this sort of, crisis that doesn't feel like a crisis, one thing it's done, for me at least, is it's shown that, the emperor has no clothes, that central bankers have been revealed to be effectively more or less powerless or asleep at the wheel. And I've cited this once or twice, but there's a great quote by Keynes, John Maynard Keynes, who wrote this, I think, in 1932 or 33, where he says, "I fear that we've basically erred in the sort of the management of this sort of delicate machine, and I fear that our prospects for growth or prosperity will be laid to waste perhaps for some time." And I think he was mostly right in that. But the one thing I'd challenge after the fact is his use of that metaphor of the economy as a machine. The reason why the Austrian perspective so appeals to me is because the economy isn't a machine. That's a sort of oversimplification of things. The beauty of the Austrian or sort of Mises perspective is the economy is us. The economy is everybody that participates in it. So the economy is 7 billion people. We'll try modeling that. Good luck. Which is why Mises called his magnum opus was called Human Action. It had nothing to do with economic modeling whatsoever. And I think that's the real danger. I think that's the real danger that's slowly been revealed to a growing number of people, that central bankers think that a small board of people can control and manipulate and tweak and do this and that with the economy. How do they know? How do they know what the appropriate monetary rate should be? How do they know what the appropriate rate of interest should be for, in the States, several 100 million people, and beyond that for billions of people? And the answer is they don't, and they shouldn't. So I don't believe in even the principle of central banking. I just worry that we have a gigantic, there's a gigantic shoe to drop, and it hasn't dropped yet. And because it hasn't dropped, maybe some people are thinking, well, it's never going to drop, or there is no problem to begin with. But all I see is a problem, primarily again, a problem of debt and sort of subpar economic growth. And that problem hasn't gone away. It's actually got bigger, but it's simply been camouflaged by the fact that when you drive rates down to zero, you get a boom in stock prices.
Tim, offer a perspective for those of us not closely watching the European situation, but hearing the headlines. And it looks like for a good 5, 6, 7 years, we've essentially had this standoff between Germany and Greece. And Germany's saying, hey, get your house in order. And Greece is saying, we don't like the particulars that you've put upon us. And so there's this standoff, so to speak. Help me to understand, why did Germany, the Brits said, hey, we would like to keep our currency. Why did Germany feel the need to go common currency? And how does the average German feel today about common currency?
I mean, make no secret of the fact that I'm sort of Eurosceptic, and I think it was a good thing that, that in 1992, which is pretty much when MICA and the city started, the sterling was ethnically cleansed from the exchange rate mechanism. So it was an entirely involuntary act. We got shoved out, but our economy is in much better shape as a result of having been sort of forced out of the system, whereas everyone else is locked into something like a doomsday machine. I'm no great exponent for the Euro project. I think one of the problems with the Euro project is it is advocating a sort of economic gigantism that I simply don't believe should happen. I think, smaller rather than larger is the answer. But I think that the project came into being relatively simplistically for one key reason, which is, Europe's been at war with itself for hundreds of years. The European situation of the last century is that France and Germany have been at war with each other twice, with clearly involvement from a lot of other countries. So the defining act of the Eurozone project was really to bind the economic interests of France and Germany together in the common currency project. So ultimately, this was a sort of, this was a social peace contract. That's my take anyway. So this transcends economics. This is all about basically ensuring that there would not be another war in Europe. And the irony is, arguably that, be careful what you're trying to prevent, because it may be that actually makes it more likely, not less likely now, given the economic instability that the project is now seems to be throwing up.
What would you say about the average German view today about not having the mark?
It's interesting. I mean, I don't know. I don't know that many Germans, so I don't know what the sort of man on the street, say in Frankfurt or Berlin is thinking. But if I put myself in the position of a German saver or a German pensioner, I would not feel particularly enthusiastic about paying for Greek pensioners to retire at whatever it is, 50 or 55. I'd feel a little bit aggrieved at having to basically reach into my wallet to bail out a country that, has clearly struggled to get to grips with just the idea of its citizens paying any tax, for example. So I think this was always going to arise as a problem, but now the sort of, we've reached the sort of the limits of what's acceptable within an economic territory where, again, you've got people who play by the rules and people who simply are almost the economic equivalent of failed states.
As I've said throughout this conversation so far, the way that I read you, the way that I see your comments, you don't say that the S&P could not double from here. I mean, you're saying, look, I don't know, but... No,
we don't know.
Right, but I've seen a great quote that I wrote down here from you. It says, quote, "Not wishing to participate in the terminal stages of a momentum-driven bubble is not bearish so much as simply sane." End quote.
Yeah, I mean, there's also a great perspective on this that I heard at a conference back in, I think it was in Zurich about 5 or 6 years ago from an analyst, Dylan Grice. And you may know Dylan from the work that he used to do at SocGen. So he was on the sort of perma-bear strategy team, along with the likes of Albert Edwards and James Montier. And they've kind of all gone their different ways now. But I remember, speaking to Dylan then and saying, look, how long can this sort of weird environment last? And his response was very interesting. He said, well, you could say the same thing about, say, the Soviet Union. So the Soviet Union was sort of born in chaos after the revolution in 1917. And you could have had an intelligence observer, for example, the CIA, basically saying every year that the system's just going to crack. It's on the point of failure. It's on the point of no return. The Soviet Union didn't actually implode until, the Berlin Wall fell in 1989. Now that's an entire lifetime. So the lesson from that is that a dysfunctional system can outlast everybody's worst fears. It can outlast you. It can outlast me. And I think that's the scary perspective. So, the one question that I think every investor would like to know the answer to is when. So if you even accept that the system's shaky and all the rest, then when do we get this sort of reset? Whatever form that reset might take, when? And that's the one question clearly that we can't answer. So, that sort of, world economy or even national economy as the former USSR analogy, I think, is very, very apposite.
Yeah, because, I do see comments from many other people from a fundamental perspective, and I'm not a fundamental guy, but I think this is more about an honest conversation about economics, geopolitics, what's going on in the world, and perhaps what's the right way to do things. But, I see very big names that offer drastically different opinions than yours. For example, Warren Buffett, it's a very rosy picture. Paul Krugman, very rosy picture. So I see people that are saying, hey, everything's great. The argument I would have for them, though, if I was talking to them was, well, what happens if we're in a bubble? So, because if we are in a bubble, which clearly there's evidence in the last 15 years that we know how to grow and pop these bubbles, if we're in another bubble, then aren't you being a little too rosy with the way that you're speaking to the populace, for example? Not you, but them.
I'm willing to believe that, the stock markets are being entirely rational in what they're doing. But as I say, if we're going to sort of debate the circumstances surrounding, let's call them bubble candidates, then you can't really put your finger on anything more powerful than the fact that that in Europe right now, that in the Eurozone, people are willing to buy bonds knowing that if they hold those bonds to maturity, they are guaranteed to lose money. Now, as a definition of bubble goes, that seems pretty close to me. In other words, this is guaranteed to lose money. The only thing, you struggle logically to try and rationalize why people would do that. And just about the only, in other words, hold a bond with a negative yield, the only remote thing that I think comes halfway close is because you may think that you'll make a gain in currency terms. Or otherwise, it's just greater fool theory that, you buy something with a negative 5 basis point yield because, you know that Mario Draghi at the ECB is going to buy it off you for a negative 10 basis point yield. So you'll make money even though it's outrageously expensive. But so I will accept the argument that relative to debt, that stocks look like the only game in town. The concern I have, though, firstly, is that you've got all these gains taking place right at the heart of the capital market structure. So, in other words, if you muck around with the so-called risk-free rate, i.e., the rate pertaining on U.S. Treasury debt, which is ultimately the bedrock of the global capital markets, and the bond market's way bigger than the stock market. If you muck around with that, then you ultimately distort everything. But I will accept the argument that relative to bonds, stocks at like fair value or stock that's attractive. I don't dispute that. The real concern I have is that the stock markets themselves are being influenced, if not outright controlled. They're being influenced by central bank policy. And that central bank policy is basically to get everybody into the stock market. I really am concerned about the idea that there's sort of this generalized perception that, the Fed's at our back. We don't have to worry. The Fed will sort us out. Well, the job of the Federal Reserve isn't to make everybody wealthy. And the idea that everyone's now flooded into the market, particularly in the form of things like low-cost ETFs and tracker funds at its all-time high, that gives me huge concern that there's a lot of, dare one say, relatively unsophisticated investors that are momentum-based, so they're just chasing things higher. And they're going all in right at the top of the market in instruments that won't allow them any escape when the market falls. The idea that, people are going into stocks and thinking, well, whatever they're thinking, we have to presume that some of them are thinking, it's okay because, the central banks are on our side. That is bubble thinking. That is a sort of bubble psychology at work that, we can't lose. And that there's some great quotes throughout history on this point. And one is along the lines of, no force on earth can stop people who are determined to grow suddenly rich. If people have got that kind of get rich quick mindset, then nothing you say or do can change that.
One last question, Tim. I brought it up earlier, the idea of okay, look, we've got ZIRP, we've got no interest income. People are paying the banks to hold on to their money for them. What a great service for that is. So, but it seems like, and you mentioned central banks pushing people into stocks, that fear has caused people, and I'm curious, you're thinking your explanation, but where is the outrage over ZIRP? Where's the outrage over no more interest income? I can't imagine 30 years ago, if you told generations that understood the idea of savings and interest income and getting to a certain point in life where you want to live off that income, I can't imagine those generations accepting that at the polls or anything like that. But today, something has changed. Something has shifted. No one seems to care one iota about zero interest income.
I agree. I mean, I think the people for whom I have the most sympathy at the moment would be pensioners. Let's say people who've, whatever they've done with their lives, maybe created a business or worked in business, and they've amassed savings, and they're now forced to eke out some kind of lifestyle on a fixed pool of savings. I have huge sympathy for that demographic, because what do? They have very little choice other than to take much more risk with their capital than they would ever have dreamed of, because clearly cash ain't cutting it. So they have a choice basically between, zero yielding cash or more or less zero yielding debt or the stock market. Clearly there are other things, but let's boil it down to the major markets, sort of bonds and stocks. Almost by definition, they have very little option but to sort of seek out some kind of, return in stocks. But that's their life savings we're talking about. So that's non-trivial capital. I have a lot of sympathy for those people. Life is going to be tough. But I speak practically on a daily basis to people who've been sitting hunkering in cash, waiting for the correction to happen. And, so far we're sort of, 7 years in, we haven't really been there. Even at the sort of March 2009 low, markets weren't exactly cheap. But then clearly we had a big bounce. But, I'm minded to believe that human nature never really fundamentally changes, which is one reason why I think there's a role for trend following funds and all their various guises, because they exploit the fact that human nature never really fundamentally changes, just oscillates between waves of sort of greed and fear. But the market never got cheap. The stock market never got cheap. Stock markets, when they bottom, trade on P's in the single digits. They trade on P's of 4 or 5 times. Well, we're a long way from that. And we were a long way from that even in March 2009.
Where's the outrage, Tim? Where's the outrage? That's what I'm curious about. Why no outrage?
I absolutely agree with you. I couldn't agree with you more. It's like there's a silent majority there that's just seething, but not making its concerns or its bafflement or its fears vocal. It's suffering in silence.
It's just fascinating to watch. It just seems like the voting blocks around the world that are democracies have just decided we're impotent and we can't fix this. And the only thing we've got is the stock market, and we're going to ride it up, even though we know damn well it could be another bubble. It's the only thing we got. So let's just be quiet. And they pushed it up really high so far. So that's all we got.
Maybe you're right. Maybe that's it. Maybe what's happened is that the stock market has basically become a pacifier for otherwise outraged investors or savers. So the non-too subtle message is, you're being crucified to hold cash, so buy stocks instead. And here's another rally, just enjoy it. Have another dog biscuit.
Okay, let's leave it on the dog biscuit. That was a great ending. I've never ended a podcast on the dog biscuit. Tim, where can we send people to read your blog, read your PDFs? Where can we send people?
Yeah, I make all the commentaries available at thepriceofeverything.typepad.com.
Tim, I appreciate you coming on again. You're always very clear thinking and offer a perspective. I always enjoy it.
It's a pleasure.
Thank you. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.